What you're dealing with right now is a really big deal. You became the president of the Chicago Fed in 2007?
Yes, September.
2007.
Right at the top of the funds rate.
Exactly. The top of the funds rate and the beginning of what turned out to be the worst recession and, global upset in a generation. Right. And so it was all about the Fed. So the Federal Reserve took really innovative steps to change the trajectory and to get us back. We didn't have any really fiscal policy other than that stimulus plan at the beginning of 2007, obviously, to rescue the financial drama that was taking place. Now you've got fiscal policy. How does that change things?
Well, I mean, we've also had a long recovery. It's been slower than anybody would like, but we've got the unemployment rate down to 4.7%. So, at this point, we're looking at resource gaps being closed, output gaps being closed, and inflation starting to pick up. So fiscal policy would have been extremely helpful back in the 2011-2012 timeframe. You say it's been all about the Federal Reserve. Well, in part, that's because, we didn't have the fiscal additional capacity after the first fiscal stimulus. The global slowdown, sovereign debt crises, Europe, and China decelerating. So there's been an awful lot that's been taking place to sort of give rise to this slower recovery. But now we're at 4.7%. Right. So I think fiscal policies that are smart, improve inefficiencies that get in the way of businesses expanding, things that help labor force growth and get trend growth up would be extraordinarily welcome. If we'd like to see 3% growth sustained over a long period of time, we're going to need to have the labor input and productivity grow in line with that so that we just don't get a lot of additional inflation. That would be a challenge for everybody.
But do you worry that just when we're about to start seeing some movement in terms of economic growth because of a major tax reform package, because of a rollback in regulations, we're just beginning to see real traction? We've got 4.7% unemployment, good number. The Federal Reserve kills it with higher interest rates by making things more expensive for people.
Well, so what the Fed has to do is address our dual mandate objectives, and I think that there's room to get inflation up to 2%, and in fact going beyond 2% a little bit to make sure that we get there, and it's a symmetric inflation objective, so that's okay. But it's not just the Federal Reserve. Financial conditions would tighten even if we didn't do anything. As you put pressure on resources, businesses are lending more, but they still are constrained. They're going to be charging higher interest rates. As the world economy continues to grow, they're also going to contribute to that restrictiveness. All of the liquidity that has come into the U.S. from abroad looking for safe haven flows as the global economy improves, that's going to balance out a little bit more. And interest rates are likely to revert back to more normal levels associated with reversion of term premium back up to normal levels.
Then there's the stock market. The stock market is up 13% since Election Day. The stock market has all these expectations up here about what tax reform is going to do in this rollback of regulation. How closely do you watch the market, and what is the market telling you right now?
Well, I mean, we look at overall financial conditions, and so obviously the level of stocks is one component. We look for what that's going to do in terms of consumer spending, how businesses are going to finance themselves and grow the economy. It's also the case that risk spreads have narrowed, so funding is a little bit easier in spite of the fact that we've raised interest rates. So financial conditions are a little bit easier probably than they were a couple of months ago in spite of the rate increase. But so we look at all of that together. The stock market's only one piece of it.
So what are the most important metrics that you're looking at as you gauge inflation and growth right now?
Well, I think continued growth in the economy, strong labor market contributing to a stronger consumer, really looking for business investment to pick up physical investment. And if anything, that's been disappointing over the entire recovery. I'm always a little surprised by that. After the downturn, the unemployment rate going up to 10%, businesses getting leaner, balance sheets getting better, and consumers struggling with low employment trends, I would have guessed that it was business investment that played a stronger role in sort of leading us out of that, but it really never happened that way. It was employment increasing, consumers improving their situation, and strong consumer spending, and businesses have sort of lagged after that because of uncertainty, because of expectations or perhaps different policies But I think it's time for the business investment side of this to pick up, and that would improve structural trend properties as well.
Yeah, I would argue that the business sector has been in the recession in the last couple of years. They've been sitting on cash because they don't know what's around the corner in terms of demand and in terms of regulation.
But the economy has been growing, and there's been less of a desire to take risks on their own part.
All right, so 2017, you will be voting for 2 more interest rate increases at least.
Well, I mean, all I've said is that the median of the FOMC projections is 3 this year. We've got 1 out of the way. I think if the growth outlook solidifies and I have more confidence and inflation is going up, 3 is for the entire year is entirely reasonable. It could be a little bit less if there's more inflation uncertainty, or it could be more if things are stronger than that.
And you say you're probably going to see growth of about 2.5% this year.
That's about right.
Can we get to 4% in 18?
Well, 4% would be really an outsized number. I think in any given year you could get something like that. But, you know, auto sales are already at, you know, almost all-time highs. The auto sector has been an important contributor to growing the way that we have. I mean, how many more, you know, so it depends on where those sources of growth are coming from. If it came from an investment boom, things like that, that led to additional employment, that would be good. I'd like to see trend growth increase in line with that, and that would be tough to do over a short period of time.
And auto, where are the other growth areas of this economy right now? What industries do you identify as growth?
Well, you know, I think the consumer has been strong for some time. I think business investment is really a big part of that. So, you know, building out factory floors to the extent that that takes place, the way that a lot of the plans are. So, I mean, things like that.
We'll be watching that. Charlie, it's good to see you.
Oh, thank you very much.
Thank you so much. Appreciate the time.
It's great to be here.
Charles Evans is the president of the Chicago Federal Reserve.